Before the world blew up in 2008, the Fed's balance sheet was about $925 billion. Today, it's $4.53 trillion. Now, that's through quantitative easing. The Fed basically subsidized the housing sector. I mean, it bought and purchased all these mortgage-backed securities. There was no market for those. Nobody wanted to buy those mortgage-backed securities because everybody was scared to death. Well, the Fed did that. The Fed basically subsidized the housing sector from about 2008 to 2011 or 12. Combined that with this quantitative easing, the infusing of capital. They basically, in essence, now you can find an economist to explain it to you a lot more sophisticated than this. But in essence, the Fed printed money to finance the national debt. I mean, the national debt went from 12 trillion to 21 or so trillion. The Fed basically printed a majority of that money to finance the national debt. Because there's got to be some accounting. We don't have to have the money, but there's got to be some accounting of that. And the Fed, once again, has assets and liabilities, but the Fed has this unbelievable ability to print money. They know no bounds. How much money can they print? JT and I have talked about this. I have no idea. I don't know how much ink they've got in the basement at the Federal Reserve that they can print and print and print and print. I do believe there is a day of reckoning. And I think days like yesterday were when the market realizes that indeed the central banks all over the world have created this artificial environment. It's not real. We can't have, basically 0% interest rates. Larry's right. There's been an increase, an incremental increase in interest rates. But I think we've gotten addicted to credit and cheap money. I think the market has been absolutely overvalued because of the Fed's intervening, the Fed's activism. And I think we're beginning to sense, because of the improving of the economy. See, a bad economy is probably pretty good for today's market because you've got the Federal Reserve as its savior. And I think when traditional rules reapply themselves, when normal economic news begins to become more important than an activist Fed. And Reb, I'll be honest, there are some people far more conspiratorial than I who don't believe we're ever going back there, who don't believe there's a way. They don't believe, and these are bright people. Incredible. David Stockman, who worked for Ronald Reagan, was his chief budget writer. Stockman believes that we have crossed the tipping point. There is no way. We are addicted to crack, will be addicted to crack till the day Jesus comes back. And he's a real bright guy. He's been in government for a long, long time. And he believes that every time you mention the potential for a raising of rates, the returning to the norms of a capitalist economy, we have these huge market swings of 1,170, and it spooks everybody. It freaks everybody out. So if you're Jerome Powell, and yesterday was the first day back on the job, and you come in after speaking with Janet Yellen saying, I believe it's time for us, I believe we've got the economy in a place that we can wean ourselves and we can basically sell the assets that we've got on our balance sheet. Was $925 billion. Now it's about $4.53 trillion. I mean, imagine that. Now, you can also argue that, thank God for the Fed. Thank God for the Fed, because what would the world look like if they didn't have the ability to basically manipulate the economy, to backstop the housing sector, to print money to fund the federal debt? Those are kind of competing theories. I think Mike and I have had some conversations about, we all get aggravated about the Fed, but what if the Fed did not have that unlimited capacity? What would the world look like? But quantitative easing started in, I think, November of 2008 is when everybody freaked out and the markets were having these huge 10% swings daily. I think, if I'm not mistaken, they purchased about $1.25 or $1.5 trillion of mortgage-backed securities, and that was put cash. I mean, that was put capital in an illiquid system. I mean, the housing sector didn't. I mean, the people that had financed all these homes to people who knew they couldn't afford them looked around one day at one another and said, nobody's got any money. I mean, these bundles of mortgages that we thought were worth X are worth X minus 300%. It was an illiquid system. And you can argue that if we didn't have the Fed, good Lord, what would have happened during that period of time. But we're having to understand that the American economy was incredibly sick at that time. I've got a real good and strong opinion about who made it sick, and it's probably more the Springsteen side of me than it is the capitalist side of me. But then you've got a Fed who in 2008 said basically we've got to restore the U.S. economy to health, and we've got to stimulate spending and growth. And Bernanke was in there, and he's a student of the 1929 Depression and what the Fed didn't do and what it should have done. But I think for anybody to believe that the reason the market sold off 1175 yesterday is simply because, traditional market forces of inflation. And I don't buy that for a second. I think when you get economic news that is encouraging, and this is kind of oxymoronic to what the majority of people think, when you get economic news that substantiates and supports the belief that there is a genuine improving of the fundamentals of the American economy, and the market vomits. And in essence, that's what's happened the last 3 days. I think you've got to look in the mirror and say something's wrong here. And I think what is wrong is, once again, these central banks have fooled reality. And they've done it through all this activism that they've done. It's not just the American Central Bank. They've done it all over Europe. Japan has done a lot of these same sorts of things. We can debate too much, not enough, just right. But right now, the Fed has to figure out a way to get its balance sheet from $4.53 trillion to some other number. It'll probably never be $950 billion again. It may be $2 trillion. It may be $1.8 trillion. It may be $2.2 trillion. But every time you get positive economic news, the Fed is inclined to say, okay, there is a reality out there that we need to react upon, and our reaction needs to be a raising of the rates to basically correct what I would call the overvaluing of the market. Back to Larry's point, I want to buy bonds. I don't want to be in the market. I don't want the risk of being in the market, but I've got to have 50 grand a year to live my life. And the only place you can go is the market. So when you raise interest rates, bond rates increase, and we can get into 30-day and T-bills and all these other sorts of things. I don't fully understand it. And once again, I understand it enough to be dangerous. But I think to say that the 1175 sell-off of the market yesterday was not because the positive economic news led a lot of smart financial minds to believe that the Fed would be more inclined to more aggressively raise rates to a more traditional fashion is asinine. It makes no sense. That is exactly what the market felt. That is why the market responded as it did. Now, do I believe there's acceleration because of electronic trading and these machines trading in milliseconds? At about 2:10 yesterday, we went from 800 down to about 1,620 down. And that's not humanism. That's machines doing this very aggressive and speed trading. And it's kind of the new market. I listened to Jim Cramer a little bit last night. New market, old market. There was a day you took an order, you made an order. There was a note made. Now it's computer generated. I think the market will be okay. I think the market's overvalued. I think the reason the market is overvalued is because of Fed policy, not necessarily that we've gotten ahead of ourselves with the fundamentals. And it's the Fed's fault. The Fed basically said to Wall Street, here's all this money. Here's all this activism. You have at it. And really bright financial minds do what? They figure out a way to advantage themselves. And I think you're going to see some pretty severe fluctuations in the market. I think very consistent with what Reggie said. Reggie believes the market's overvalued. Now, I believe it's overvalued primarily because the Fed will be forced in 2018 to try to begin creating balance in its balance sheet. In other words, it can't have that many liabilities and that little assets. It can't be that upside down in what it has on its balance sheet. And secondarily, I think you've got to figure out a way to get interest rates back to some state of reason. And at 0.25 or 0.50 or 0.75 or 1.0, that's not normal. And I think when we start heading down that road, Reb, I think there's going to be a lot of pushback from the market. Why? Because it's addicted to crack cocaine. And we've let it have its prescription of crack cocaine for the last 10 years. And now we're taking it away from it. And I think the market will have withdrawals and schisms as we try to work back to some sense of normal. I didn't learn that at Harvard. Learned that in Pamplico. Take a break. Back in a minute. I want to thank our friends at QAT. You can find out more by visiting their website at teamqat.com.